This one's really messy. The way a tariff works is really basic. It's basically just a corporate tax. So, and it's paid by the domestic corporation. And the question is whether can that corporation then pass on the cost?
The United States has had significant barriers to trade in many, many countries. Tariffs, non-tariff restrictions, intellectual property being stolen, um, currency manipulation, all of these things have made the playing field for the United States to be a manufacturing zone weak. The goal is to increase onshoring in critical technologies. The tactics are a big mess.
So Matt, what's the market up to today? I haven't checked.
Oh, I'm sure everything's fine. Sure, everything's fine. I mean, it's April 3rd. This is like April Fool's Day number 3, right?
Yeah, I wish it was. I just checked before we got on, and the S&P is down 4%. So obviously, things have gotten a little bit ugly here. Liberation Day the market at least did not enjoy Liberation Day. So what we're going to do today, and we always do these clip shows where we try to get the best insights from our guests. And we recognize we've recently had on both Cullen Roche and Andy Constan to deal with a lot of the issues we're all thinking through as investors right now. Tariffs, the national debt, DOGE, all of this stuff. And we got a pretty balanced take from both of them on these issues. So we thought we would do a special episode today. You know, we're trying to, these are obviously tough things to talk about in public because you're going to get all kinds of negative comments, but we're not PhD trained economists. We are people who manage money for people on a daily basis. We have to think through these things. We have to talk about these things with clients. And we wanted to talk through in the way you and I might talk through if we weren't on a podcast, how we're thinking about this and try to get to the facts. So that's what we're going to try to do today.
We are going to try. And it's how do you stay long-term? How do you keep your head about you in the face of adversity? And how do you figure out where and what should I be rebalancing? What should I actually be doing that's constructive for me over the time horizons that I need this portfolio to do whatever I need this portfolio to do? And you don't have to be. And most of us are not PhD economists. So we need people we can talk to about stuff like this. You're one of those people in my life that I talk to about stuff like this, and let's hash it out. Luckily, we have access to some really friggin' brilliant people, and we can take some of that. And I use the stuff we get on this podcast all the time in my professional life. So what better way to do this than break down some of these clips?
Yeah, so we've got, as we mentioned, we've got probably 30 minutes of clips here from both Andy and Cullen, and we're going to try to break these down, and we're going to try to look at both sides of this. We're not going to try to get our own political views or anything in here. We're just going to try to understand what could go wrong, what could go right, what is going wrong, what's going right. Like just try to think long-term and short-term, just thinking about all the implications. So the first clip we have actually doesn't relate to this stuff, but it sort of does, in that Andy Constan has constantly been talking on Twitter about this idea that Trump and Powell both want the stock market to go down. And that was a little bit of a tongue-in-cheek thing, but I think it's just important for those of us that are investors of thinking about there is a long-term goal some of these policies are trying to accomplish, and that long-term goal comes with short-term pain. You can disagree with the long-term goal, you can agree with it, but what they're trying to accomplish right now is not potentially great for the stock market, which helps us explain what we're seeing. So here's Andy talking about that.
I think what all of them want is a slower growth to kill inflation so that the economy can normalize. And that's not good for the stock market. It's good for the bond market, which during the first Trump administration, Trump often cheerleaded the stock market. And perhaps, I think it's likely, validated the success of his administration on the returns of the stock market. And personally, I think that's a much more riskier thing to do now. And Secretary Bessent has made it very clear what he thinks success should be measured by, and that's the bond market. And I think what he's trying to do is convince President Trump to also think about that. And so why does the bond market rally? Why do long-term bond yields fall? And that's principally due to deficit reduction, which gives more confidence that that there'll be less issuance and less spending, and slower growth and inflation that is truly killed. And so you add up the policies of, and certainly um, uh, Chairman Powell wants the same thing. That's literally his goal. No one wants the economy to roll over and cause a recession with high unemployment or anything like that. But slowing the economy to kill inflation does make a great deal of sense for all three of them. And then you look at the policies, and the policies are consistent with that goal. So that's what I'm really trying to get at, that all three of them, no, but they don't want to bet on the stock market. Maybe Trump does, but he's being convinced not to. They want to enact policies and monetary policy that will kill inflation and return growth and to normal and be sustainable.
So the idea here is they want inflation down, or at least, Trump wants inflation down, Powell wants inflation down. Trump has said they're targeting the 10-year. They want rates down. They want the deficit down. Now, whether you agree or disagree with how they're getting there, those things are not great in terms of the short-term performance of the stock market.
The core advice here is be defensive on multiple fronts, because we're trying to look past what these things mean as investors. We know there's a bunch of stuff that they want to slow things down to get where they're going to go next. We also know that we have an administration that's just come in and they have the ability to make some of these rules, flexes, changes, whatever you want to think of. Like, this is their opportunity to make these big sweeping changes. It's not going to stay like this long term. Some of these stuff is going to stay in place, but this is going to be dynamic. It's going to be evolving. All of the initiatives, when you stack them up right now, are taking an anti-growth stance. So figuring out as an investor how to be defensive on multiple fronts is still the most important thing to probably be talking through with whoever professionals help you in your life.
And the challenge I've been facing talking to clients, and you probably have as well, is a lot of people came into this thinking about Trump term one. And they thought about Trump term one when he tweeted, if the Dow goes down 250 points on consecutive days, the president should be impeached, whatever it was. You had a pro stock market. Like, his goal, one of his stated goals, was keeping the stock market up. Now he's thinking about a longer term policy, whether you agree with it or you disagree with it, that in the near term, he's willing to let the stock market go down. So people are waiting for the Trump put and the Powell put and all this stuff. And right now they're not getting it. And it's just so important to keep that in context as you think about this.
Yeah. With a bunch of people who definitely don't want a protracted, long, ugly recession and bear market combo. They're clearly trying to press this and see how close to the edge they can do this. We'll see if they succeed or not. It could end up badly. It could end up being something where I will not be surprised if 6 weeks from now, all of a sudden we have a pro stock market president too. It's very possible. I look at a lot of this as short-term noise when there's a political majority trying to make a really big impact. And we know a big part of that impact is, can we slow growth enough to help cure this inflation problem? And hey, with Besant out there saying to focus on the bond market, as he brought up in the clip, pay attention to what they're paying attention to. And they are telling you what they are paying attention to right now.
So speaking of what we're paying attention to right now, the stock market's down 4% because of tariffs. So let's start with tariffs. And when we had Cullen Roche, Cullen is as good as anybody at thinking about the plumbing behind the scenes, about thinking about how all this stuff actually works. So here's Cullen talking about the impact of tariffs.
Yeah, this one's really messy. And well, a lot of this is really interesting because we've never seen this, like,
Right.
in the way that it's being unfurled. I mean, we basically have had almost purely free trade for the last 80 years. Tariffs weren't even a meaningful policy, until really like the pre-Great Depression era. So a lot of what we're seeing is just brand new. But, I think from a really basic perspective, so first of all, the way a tariff works is really basic. It's basically just a corporate tax. So, and it's paid by the domestic corporation. So when China exports goods, a Chinese firm exports, puts 1,000 iPhones on a ship, they arrive at Los Angeles, and when Apple receives those phones, they pay the import tax at customs. And so they're paying a fee that is independent of anything China actually did. So China's not paying this. It's a purely domestic corporate tax. And so from a very basic economic perspective, this tax, and I think of taxes, all corporate taxes as this basically, that all corporate taxes they result in producer price inflation. So they raise the cost of manufacturing anything. They reduce margins instantaneously for businesses when they're incurred. And the question is whether can that corporation then pass on the cost? So, whether or not the producer price inflation from the tax results in consumer price inflation, which is the things like CPI or the personal consumption expenditures measure that the Fed uses. Those are the consumption taxes or the consumption inflation that we all measure, and the ones that we live and experience at a consumer level. But whether the corporation can pass those on is yet to be seen. So far, I've talked to a lot of people who, like I was talking to somebody over this weekend who runs a big pharmaceutical firm, and he was saying, "Oh, we have so much pricing power that we're going to have no problem passing this all on." That's a very different story for someone in a much more a low margin, for instance, like supermarkets, for instance. They're going to have a much harder time passing on these extra costs that they're incurring to consumers.
So whether you disagree with them or agree with them, the plumbing is right here, which is at the end of the day, this is a tax on the domestic corporation, and they have a decision to make whether they eat it or whether they pass it on. And so I think that's just thinking about those logistics and getting that right before you have an opinion on this is a good idea.
Yeah, think about what happens. If you're the domestic corporation, you are basically going to have this additional cost, this tax, eat into your margins. And you have to decide if you're going to push that out or if you're going to absorb it, and if you're going to absorb it, by how much. It's also really important to think this will end up hitting different companies, different industries, different sectors in different ways. There's an incredible amount of nuance here. There's an incredible amount of decision making that's going to come down for all the very intertwined and nuanced actors in between. And, the market reacting the way the market is reacting today is indicative of how many variables are at play in this equation. We know that this tax is going to hit them at the corporate level, for the domestic corporation level. They have to decide, we're going to try to push this on the consumers, or are we going to absorb this? And if we're going to absorb this, for how long? If we're going to push it on the consumers, for the how long? That's going to take time to find out what the hell they're going to do.
And to your point, it's different for every single product. So like in Lutnick's interview he did, and Andy I think mentions this in a clip we're going to do in a little bit, like they mentioned mangoes. Like, you don't want to tariff mangoes because we can't make mangoes. So therefore it would be a bad idea from our perspective. Now, if you have some other product where the U.S. company and the foreign company are priced similarly in the market, and the U.S. company has capacity to build more stuff, a tariff can make more sense in that situation. So much of this is on a case-by-case basis, and people want to have this broad strokes about, tariffs as it applies to everything, but every single case is different.
Yeah. And the market is reacting to tariffs as they apply to everything, because we are lacking any type of comfort around, I'm not saying certainty, but any type of comfort around, we understand the breakdown of these rules, and we understand the breakdown of the decision-making at the corporate level. Some companies, to Andy's point that we're going to get to, like they might have a mix of mangoes, and what's the other thing in his analogy?
I forget what the second one was, but yeah, mangoes is the one where it doesn't work.
Anyway, you have companies who have more than one product, more than one service, or some mix too. There's a lot of ways for this to play out. The market is definitely reacting to a broad brushstroke analysis of bad. It is not nuanced at this point. We are reacting on sentiment here, and we got to see where this is going to carry us over time.
Yeah, and to your point, I mean, the policy wasn't that nuanced, which is probably why we're getting less of a nuanced reaction. Like this will play out over time, and we'll see what happens. But I also think it's important to look at, like, a lot of people will look at tariffs and just think, there's been tons and tons of negative stuff about them. And obviously a lot of it is justified, but there also are some cases to be made for tariffs. So here's Andy Constan, and inside of his answer are some of those cases.
I absolutely do. I think that, but it's a policy choice. I think, for instance, I think my favorite person to read is Michael Pettis on this topic, and I'll quote generally his theories on this, and they're standard economic theories. They're not just made up. A decision, the United States has had significant barriers to trade in many, many countries. Tariffs, non-tariff restrictions, intellectual property being stolen, currency manipulation, all of these things have made the playing field for the United States to be a manufacturing zone weak. Now, there are lots of other structural reasons, like a workforce that has a certain standard of living and certain wage expectation that makes manufacturing in the United States hard, but the playing field is not even. And so I think it's a totally reasonable thing to decide that you want to change the nature of trading with the United States, global trade with the United States. And the Trump administration is going about that. And tariffs are a totally reasonable tool to do for that. And what your goal presumably is to reshape trade. Now, you can do that by tariffs, and if our trading partner keeps tariffs high, or you can do it by tariffs so that they'll lower their tariffs and then you remove your tariffs. Lots of strategy can go about. But I think the takeaway is more important than the tactics. And that is the goal of the Trump reshaping of global trade is to increase manufacturing in the United States. Not in Mexico, not in Canada, not nearshoring, but literal onshoring of manufacturing capability in the United States. Michael says this, I think it's an excellent point, that when you do that, it doesn't necessarily increase your GDP. All it does is shift the amount of share of your GDP from consumption to manufacturing. And so essentially what that shift does is it lowers the amount of GDP that's created by existing job holders and increases the amount of GDP that's created by new job holders who fill these manufacturing jobs. That is a transition, and that can be painful. It requires people to learn new skills, to find new jobs, and that takes a significant amount of time. That's not something that's going to happen on April 2nd. That's going to happen 5 years from now as this ongoing rebalance of our trade happens. And what it also requires is our foreign trading partners to reduce their share of their GDP on manufacturing and increase consumption. And culturally, that's hard for them to do. And so it's not surprising that China is focused on increasing consumption when they're threatened by decreasing manufacturing. And so that whole thing is all happening. It isn't net certain that the US GDP will increase based on this. What is important, and I think a very reasonable goal, is if you believe that the geopolitical situation is such, and we saw this during COVID, and we see it when we have conflict, military and geopolitical conflicts with our enemies. If you believe that it is important to have certain critical industries manufacture onshore for national security reasons, you have no other choice. I mean, you could do other tactics. You can do things like what the Chinese have done, which is subsidize their manufacturing. Or you can tariff. Lots of things. The goal is to increase onshoring in critical technologies. The tactics are a big mess. Nobody knows how they're all going to work. Nobody knows what the tariffs are going to be, how long they're going to be kept. Are they well determined? Like, you don't want to tariff mangoes because we don't make mangoes in the United States. But you do want to tariff maybe semiconductors because you want to build critical industries in the United States. And so the actual choice of what the tariffs are and how they're applied, and then more potentially equally importantly, how our trading partners retaliate.
Again, this is not about any specific tariff policy we're doing right now, but in general, there are some cases to be made for tariffs. I mean, one is our trade relationship with other countries is unfair in certain cases. You have intellectual property theft. You have higher tariffs on us than other people. You have, countries that are supporting their domestic companies at the expense of, again, who are competing against our companies. So there are things, there's national security as an example. Like if there's a certain industry where we want domestic production for national security, that can make sense. So again, I'm not agreeing or disagreeing with any of this, but Andy had within his answer a bunch of reasons where you might want to use a tariff.
Whenever we hear the word policy, and this is one thing I've just learned helping investors over the years, whenever we have anything with a policy, it always pays to step back and say, what is the goal? What is the desired outcome of this policy? What Andy does an excellent job of here is just stating that the goal of this policy is basically to onshore manufacturing capabilities in and for the United States. We want to basically take critical technology and figure out a way to onshore it. And it was mangoes and semis. Thanks, Andy, for the mangoes and semis. You had analysis here. But this idea is the goal of these tariff policies is to get those critical manufacturing jobs, factories, whatever here. And we are perhaps in a ham-fisted, unnuanced way going about trying to get to that policy goal. We should expect the broad communication to start to narrow from here. And we should expect more policy clarity, both from how's the progress on this going to work and companies saying, here's what our plans are to do with this thing to react. When we hear policies, no matter what, if you agree or disagree and however strongly in either direction you are, stepping back and saying, what is the goal of this? And how do I understand that goal in the context of everything else I'm doing is an incredibly useful exercise. I love the way Andy broke that down.
And the only other thing I would say in favor of it is, I'm a terrible negotiator, Matt. I don't know if that's comes as a surprise to you, but I'm way too much of like a compromiser right from the beginning. Like I start with my best position, like the most fairest position, and then I just get negotiated down to the unfair position. So it never works for me, but there is a case to be made that this type of tactic does work sometimes. Like when I'm up against the people that come in with a ridiculous, outrageous position, and then they end up settling on something that's better they would have gotten in the first place. Like that is part of what Trump does. And that's part of what's going on right now is sometimes you can have these things where this is not our long-term goal to be at these levels, but we think we're going to get a better outcome by leading with these more aggressive, levels at the beginning.
Yeah. It's a strategy. It's a strategy, and it's not the strategy that you or I would use, but we're also not the president. And this is the strategy that we are now dealing with in the world around this situation. We have to step back. We have to look at for what it is. What is that strategy? How is it being played? What are those policies? How are they being played? And then what do we need to do to protect ourselves, our portfolios, whatever else? You have to have an objective view on this stuff.
So this other issue, which we talked about on is this issue of bringing manufacturing back. And so we asked Cullen Roche about that and how feasible it is.
I sent you guys this chart of manufacturing as a percentage of total U.S. employment. We're just not a manufacturing economy anymore. I mean, it's crazy to say that because we still do manufacture, it's $2.5 trillion per year of manufacturing. That's the size of the component of GDP that goes into manufacturing, which is, that's like the size of the entire Canadian economy. So we make a lot of stuff domestically. It's just that over the last 80 years, the U.S. economy has changed fundamentally. We've transitioned increasingly away from manufacturing things, more so to, specializing in things like intellectual property, building technologies, and more importantly, services. Like the U.S. economy has become a huge services economy based on this sort of intellectual property, people who are experts in, medicine and the law and, consulting services, things like that. So the U.S. economy has very fundamentally changed in the last 80 years. And so whereas manufacturing as a percentage of employment was 35 to 40% of total employment back in, say, 1940, it's now something like 8%. And this is a trend that this occurred way before the late 90s when multinational corporations started outsourcing everything. This was a trend that was in motion and in a steady trend way before that. And so this is something that I think is just very fundamentally driven about the way that the largest developed economy in the world has just fundamentally shifted into being a much more diverse primarily tech and services oriented economy and not so much a manufacturing economy. So, I don't know. Can you reverse this trend to some degree and onshore some of this manufacturing? I'm sure you can, but you're not going to change this economy back into a manufacturing-based economy like it was back in 1940 or 1950. That's just not fundamentally what we specialize in. And so, like economists talk about this thing called comparative advantage, and that's basically it's distributing manufacturing and output to where it's best utilized. And the way that the global economy has operated is that increasingly the rich developed economies have increasingly outsourced to the comparative advantage of building things in emerging markets where lower wages and people that are better at using their time to build things can actually benefit domestic consumers in a way and domestic corporations in a way where we're able to outsource that stuff and not have to rely on, higher cost of labor and frankly, just less efficient workers to build it here. And so, the other sort of worrisome thing about this narrative is that, not only is the macro trend so gigantic and working against everything that this, I think, tariff policy is trying to reverse. But the more important one, I think, is that going forward, what's going to happen to manufacturing going forward now that AI and robotics is becoming so important? I mean, I wouldn't be shocked if manufacturing as a percentage of total employment, maybe it won't go to zero, but it's going down more. It's 8% now. I wouldn't be shocked if it's 5% in 20 years. And that's just because the efficiency of robotics and AI is going to continue. It's going to continue to be this sort of huge secular trend that it just drives the number of people who are actually building physical things in our world to be reduced. So I don't see how tariffs are going to reverse this trend.
This is an interesting nuanced thing because to some extent, we learned during COVID that having certain things manufactured in your own country is a good thing. But then we've got the other problem is that other countries can manufacture things a lot cheaper than us. Like Cullen talked about the idea of comparative advantage. And so it benefits us to buy them from other countries. So this seems like, and then obviously there's some national defense stuff. There's certain things you just want to have manufactured here. So it seems like an interesting thing, but to cover Cullen's overall point, like if you look at that graph, I mean, to think we're going to go back to the manufacturing economy we once were, that's not going to happen. It's a matter of the gray area in between and where we're going, I think.
Asking this question of where is capital best utilized and why, that follow-up's really important because yes, we do want critical infrastructure without theft, without all the other stuff. You want that happening here. You want to make sure we've incentivized the reasons to do that stuff local to us in the US makes sense and we can do it here. But there's other stuff, back to the mangoes or back to something silly. There's other things that we don't want to have to do here. Like capital is best used somewhere else for somebody to do this for us and for us to be able to buy it. How that plays out on the global scale, to your point at the end there, I don't think we go all the way back to where we were as US as the dominant manufacturer. But do we have a different relationship with where we sit in the world? Extra, please, like read the Pettis stuff that that Andy's talking about. Read the Peter Zion books. Like, do we go back to a different version of this where we're allocating differently between the US, Canada, Mexico, and some of our other trade partners? Like, yeah, I could see that's where we land in 3, 4, 5 years on a lot of this stuff as we refigure it out. We're not going to make everything here. That's an unrealistic goal, and I don't think that's the goal of the administration here either.
Yeah, and if you think about something like the iPhone, I mean, if you said I want to make the iPhone, purely in the United States, I mean, the iPhone is going to cost a lot more money. And that's just the way it is. I mean, the reality is our labor is way more expensive than it is in some of these other places. And, we don't have the facilities built to do that now. I mean, that's just the reality. And maybe some people will say that's a price I'm willing to pay, but it is the reality. And there's always, to your point, there's always trade-offs in this stuff. And the only other thing that I thought was interesting is how robotics is going to play into this, because to some extent, maybe that is something longer term, not now, that does bring some of this back to the United States. Because if you think about it, if the stuff can be made robotically and then this difference in labor cost isn't as big of an issue, maybe we will be able to onshore more things because we can do it with robots.
AI and robots, that might be the factories. It won't be the jobs. Saves everything. Yeah, once you put it on blockchain, just imagine, Jack. Imagine.
That's good. I love that, Matt. So another issue that we've had in the, that really relates to all of this and has been going on in the government in terms of what they've been thinking about is this idea of the national debt. And Ray Dalio had a book recently, I don't think it's actually out yet, or it might be out in like PDF, but it's not out in print or something like that. But anywhere where he brought attention to this idea that the national debt is a major, major issue for the country. And so it's something we've been asking a lot of our podcast guests. So here was Cullen's answer in terms of how important or how big of an issue this national debt is.
I'm kind of famous somewhat for downplaying the risk of the U.S. national debt, just because the way that I view it in the scope of the global economy, the USA is the best house in a bad neighborhood of fiat currencies, and it's just there's not even a close second. So I don't see, if you were going to pick a fiat currency or a debt market that was really, really risky, the U.S. is just it's one of the last ones I would pick. I mean, there's probably hundreds of other countries that are more at risk with their national debt than the United States. And so as the reserve currency issuer, I just don't see it as a huge problem right now. But there is some, I think, legitimacy to the worry in that I sent you guys a chart of government spending as a percentage of GDP, and it kind of shows how there is a level of creep in the percentage of government spending relative to GDP, where this number has increased. And I think one of the lessons from COVID is that you can get big inflation from government spending. And so that's the big risk from all of this, is that if we run big deficits, big spending, you can ultimately get big inflation at some point. And so, like during COVID, we ran the government spending as a percentage of GDP went up as high as 45%. And that obviously contributed to inflation to a large degree. And so when you get levels that are, I would say over 30, 35, 40%, that's going to cause inflation. And so that's a real legitimate risk, is that you get this level of creep in government spending where they're spending so much money and doing some of it inefficiently enough that you're just getting a bleed through into inflation, and you start getting higher and higher levels of inflation. The question is now, right now it's like we're at like 28% in terms of spending as a percentage of GDP. That's not that far off from really the level that it's been for a lot of the last 30 years. And we know that, I think a lot of people, when they think about inflation, they say, well, inflation is all derived from the government or something. And I think we kind of know that's wrong. I think you can say that government spending causes some sort of baseline level of inflation, but there's a lot of other factors that also cause inflation, because we've had this creep in government spending for the last 30 years, and inflation has fallen that whole time for the most part. So, I mean, before COVID, inflation was falling from basically 1980 until 2020. So for 40 years, you had a falling rate of inflation that whole time, which to me very clearly says that there are other big trends that have mattered more than government spending. And that probably, I think you could chalk that up to probably slowing population growth and things like, hyper technological growth. Those are deflationary trends that they've more than suffocated any creep in government spending. So, is there a risk though that you could get increasing levels of government spending that bleed into inflation? Yeah, I think it's worth thinking about.
So I think what he was getting at, and this is what you'll see a lot of, economists say, is that ultimately the price of the national debt is inflation. And maybe not as much the crisis, Cullen wasn't a believer in the Ray Dalio crisis situation, but that over time, this could result in more inflation. And inflation, as we know, is a regressive thing. I mean, inflation can be penalizes people who spend a higher percentage of their income. And so that can be a bad long-term thing, maybe not a near-term crisis in his mind, but something that is worth paying attention to if it impacts inflation over time.
I love the way that he breaks this down just in terms of creep. This is no different than lifestyle creep. This is no different from anything where there is a point where this becomes problematic and policy starts to work against it. So understanding we're not there now, that's part of the reason this administration feels like it can do what it's doing. It can lean on some of the stuff that it can lean on. It thinks for whatever reason, it thinks it's a safe time to try to stress the system out in this way. But, if Cullen's taught me anything, it's to stop worrying and learn to love, the economic time bombs that everybody else is pointing out. Dr. Economic Strangelove over there. with these lessons. I don't know if it's going to end well or not, but I take comfort in seeing that we're still in the creep scenario. We got to see where it lands us over time. And I know from other people who study this stuff far closer than I do, we're going to see as we get into the end of 2025 what the state of the economy is, what the state of inflation is, how we're going to reapproach the net debt issuance that's coming later this year. Stuff's going to get really real, really fast inside of this calendar year, depending on how these policies play out over the next, call it 6 months. We're going to know a lot more, I think, in 6 months how this is going.
So we asked Andy the same question about the national debt, and here's what he said.
Ray's book, unfortunately, doesn't actually come out until September. I've ordered it. And he's on a speaking tour to publicize it. And of course, he's selling a book. And having worked with him for a number of years, I would say he thinks big thoughts, and they don't necessarily play out in the time frame he has them. And the way he manages money is very different than the way he sells a book or writes a book for them. So I'm not going to take much from that. But to answer your question, I guess the question that one has to ask is, well, firstly, you have to understand the mechanics of money and know that 87% of our debt is held by us. Like, we owe the money to ourselves. And as long as the saver is willing to lend it to the one who receives the spending, that can go on in perpetuity. Now, the consequence of that type of financing is that people have more money to spend, and that has an ongoing inflationary pulse that does not affect each of the cohorts in a similar way. Inflation doesn't affect people equally. And so if you're going to go through a continued sizable increase in our national debt, you're going to start pinching people in different ways. And that can lead to political crisis. It can lead to political policies that can lead to wars and, revolutions and things of that nature. And so you always have to be concerned that the outcome of issuing a lot of debt is destabilizing to the citizenry. And so that's one, I haven't read the book, but that's one possible risk. The other risk is that the people who buy our debt, including foreigners who own a significant portion of our debt, stop buying. Now, foreigners are in an interesting position in that they have to own U.S. assets. And the reason why they have to own U.S. assets is because they get paid in dollars when they send us stuff. And so they're going to have dollars. Now, they can keep them in a bank, or they can buy equity in the United States, or they can buy hard money like gold, or they can buy land or factories or all sorts of things. But mostly they buy treasuries because they're very liquid. So it's possible that one day they say no, and that causes U.S. people to now have to buy that excess debt, and that can be difficult. So it all comes down to a tipping point. I mentioned a revolutionary tipping point. There could be a market tipping point, though that seems very unlikely without market tipping points in other currencies at about the same time. But that's the sort of existential issue. The big problem for me, and this is just a personal issue, which is the reason why we have this debt is because it has allowed the United States voters to consume in excess of their production for 40 years. And at some point, and so their standard of living increases in the United States, by and large, have been very high because of this debt, financed with debt. at some point, somebody's standard of living, either a generation or a cohort within a generation, is going to pay with a lower improvement or possibly even a negative impact on their standard of living. That's the inevitable outcome. And so I just don't want to put that bag on on a future cohort or a future generation. And so I'd like to see a curtailment in our deficit. And that has to happen, in my view, in two ways: lower expenditures and increased taxes. Unfortunately, no one wants to do both. One party wants to do one thing, the other party wants to do the other thing. And so we don't make much progress on that. And so that continues. But that's what I'd like to see. Unfortunately, it means that we'd be paying back some of this improvement in our standard of living today. And no one wants to do that, and the voters don't want to do that. And so it will take a tremendous leader to go through a period of higher taxes and higher and lower expenditures. And so far, our leadership has not done that, and maybe Trump will, but so far we've yet to see it.
So there's so much in this. First of all, like obviously Ray Dalio is a far more successful investor than I am or ever will be. You do have to be careful though with these great investors when they make these proclamations, especially when, Andy had mentioned this in his clip, when they associate a time frame with it. And so if they say there's going to be a national debt crisis, and I think I was listening to Odd Lots with Ray Dalio, and he was like in 1 to 3 years or something like that. They don't know that. He might be completely right. He may be proven correct in the long term, but like I've learned over my career that even these great investors can't get the timing right on these things.
Go figure. Like they're still humans after all. Beyond that they can't get the timing right, and the point that Andy makes here about you will destabilize certain points or groups of the population. I think this is really important too. We've talked about it a lot, how all inflation is personal. We have CPI at the grand levels, we have PCE, we have all this stuff that we can measure it, but it's experienced differently by different cohorts of the population, whether by age or demographic or whatever else. These policies, the debt situation, how inflation manifests, depending who it hits and how, will determine what the political response is. The bottom line is, like, if you mess up everybody on Social Security and Medicaid, that's going to affect midterms differently than if you tick off all the millennials or whatever the other bigger demographic cohorts are. It's a thorny issue, it's a complicated issue, and it's going to play out in different ways. Destabilizing, that's the key word that I'm taking away from Andy on this. It's destabilizing in categories you can't really predict. You can't really predict the time frame on. So God bless Ray Dalio and the chicken nugget. The rest of us are just going to see what happens.
And it was interesting because Andy thought there could potentially be a crisis eventually, but it was a different kind of crisis than Dalio was talking about. Like Dalio was talking about more maybe like an economic crisis, like people don't want our debt or anything. Andy's talking about a political crisis. Like if you have this inflation and this inflation is unfair against people in the lower income ranges, you have kind of an uprising type thing that we're having right now. So maybe there will be eventually a crisis related to national debt, but it might not be the crisis Ray Dalio is talking about.
And to Andy's point, at some point, we have this debt, as he said, because voters have consumed in excess of production for 40 odd years. So I don't know if this is, raining hell back on the boomers or what it's going to mean. But yeah, the long-term ramification here is if you rebalance global trade that we've experienced for this period of time, if you rebalance the distribution of wealth around the world for this period of time, then somebody has to step back. Like there's the pie always adds up to 100%. If we're redistributing internal to that in some way, shape, or form, you're going to feel it. And maybe somebody feels that in America. That doesn't feel surprising in any way, shape, or form to me at all.
So one of the things that's being done to try to deal with the debt is this idea of DOGE, led by Elon Musk. There's been so many different takes on, whether this is good or bad or how much they can actually save. So we asked Andy what he thinks.
I'm not an expert, but I've looked at those numbers from a bottoms up standpoint and made estimates of what I think is possible. One of the stories is that we have contractors, and I think the number for the contractor number is something like 700, about 10% of the budget, in which the budget, most of the budget money actually just goes to people. like Social Security, salaries for military, all these things just go to people. But some of them go to contractors for services that they provide the government. I think the number was 750 billion out of the 7 trillion roughly of expenditures. And one of the conversations that has happened is let's renegotiate those contracts, squeeze the supplier, squeeze the contractor, so they either reduce employment or they provide the service that they're providing to the United States for a lower price. And listen, we all think about that. Hey, let's cut our, the salaries of our service providers. That's a pretty good place. Now those people are part of the private economy, and so they're probably public companies and all that. So you have to recognize that impacts them as well, impacts on employment, et cetera. But pick a number. Is it reasonable to assume that all of the 750 billion of contracts can be renegotiated? And to what? 10%? 40%? Well, it's probably somewhere around 10%. And so that's 75 billion. And so when I added it all up, unless you actually stop money going to real people, like Social Security, Medicare, you really can't get much more than 300 billion out of that. And that includes all the fraud and waste and all those things that DOGE focuses on. But, that's just me. That's sort of where I'm at. I'm all for Powell. One of the things that when you talk about this stuff, people are like, well, you must be pro-government if you think or you must be naive if you don't think we can cut the deficit by $2 trillion. And I would say, no, I'm just doing the numbers. And if you want to, you can cut whatever you want. There's certain things you can't, but like the interest, but you can cut whatever you want, but there's just a consequence and there's a political reality and whether you can do it. And so my outside number is 300 billion. My inside number is 100 billion per year. And I think consensus is closer to my lower number at this stage.
Yeah, it's challenging for someone like me who doesn't know a ton about this. Just when so much of this is done, back and forth, both sides on Twitter. If you remember the thing about all the people that were dead, that weren't marked as dead in the Social Security database. On one hand, you're like, well, that's a big problem. And then they're like, well, we're not actually paying them, so it's not a big problem. And then they're like, well, actually, they're applying for different programs rather than Social Security, so it is a problem. And you just see that back and forth all the time. And it's hard to figure out what to make of it.
I think that I basically assume that everything I read on Twitter is propaganda, either for or against anything that's happening. And I would say that without a doubt, the DOGE effort is more about propaganda so far than anything. And that is great because one thing about propaganda, it gets people moving. Is it the way I'd do it? I don't know. I mean, if you didn't put out crazy numbers, or if you didn't say, we're going to the moon, would you ever get there? I'm not so sure. So I get the idea of highlighting these crazy things that turn out to be false. That wouldn't be my way of going about it, but I get the idea. And so I'm assuming that it's all propaganda. And so what I do is I just say, okay, what can be done, what has been done, and what will be done through legislation.
There's a bunch of good takeaways from this. First of all, I think regardless of what any of us think, I think the idea of this in theory is good. I don't think anybody would disagree that there is waste in the government that could be dealt with. And then also the way the political system works makes it unlikely for that waste to be dealt with. It makes it very difficult, like inside of the current system, for that to work. So I think that the concept of DOGE, and Andy was acknowledging this in the clip, is a good concept. And I think that really the disagreement comes on the execution.
Yeah. I love this idea of just DOGE as a propaganda tool. That makes total sense to me. New administration, you want to shake stuff up. You find the most extreme things to shake up by pointing out examples of waste and all the other stuff that's here. And they're not wrong to say there are examples of this and we can highlight them. The math gets a little squirrely. I like Andy's breakdown of the math and how we would approach it, but as a propaganda tool for the beginning of the administration, I mean, we're already talking about Musk stepping down, right? Like that's already the path that we're on with this. This is a propaganda bazooka at the beginning here, and probably also indicative of yet another thing that we're going to see phased in and then phased out by this administration. Probably par for the course for the way this first year or two is going to go.
Yeah, and to your point on the estimates, I mean, Andy was kind of talking about in the $100 to $300 billion range. I was actually listening to a podcast with Darius Dale yesterday on Jack Farley's podcast, and he was talking about 500. He thought was reasonable, and these are obviously incredibly intelligent, smart people. I mean, Elon Musk, I think, is talking about $1 billion or something like that. So it's hard for the average person to figure out how much you can save. And I mean, all of us can have opinions, but to be honest, like, what do I know about the federal budget? I mean, I do know that what makes it a challenge is there's some very large line items, Social Security, Medicare, interest on the debt, and defense that are about 2/3 of the budget. And so that makes it challenging, but by the same token, they are attempting to attack some of that. I mean, and there's been talks about cuts in defense spending. Obviously, if you get rates down, interest is a little bit better. There's waste in Medicare and Social Security. So maybe there's more than I can think of. But it's a challenging thing for investors. And, I don't know the answer to this, but I think it's just good to try to look at the facts on both sides. And just one other thing I'd say before we stop is this idea, again gets back to me being a bad negotiator. This idea of the benefits of propaganda you brought up is important. It's like, it's never the way I would do things, but like in a lot of times when you come up with these crazy examples, if you're trying to get something done and you come up with the most egregious example of the problem, you get public support behind you. Like if you think about it, if you put me in charge of DOGE, what you probably would end up with is something on the lines of Ross Perot. So you would remember him with the charts and the graphs, and like talking to the American people. Like that's basically what you would end up with me, and like nobody would listen to me. So maybe there is a benefit of saying, like, let's point out the crazy examples here to get public support for what is an overall good.
This is good. You could be Ross Perot. I'll just be the Dana Carvey Saturday Night Live impersonation caricature of it. It's probably about as good as
we could do it simultaneously together.
Yeah. But again, I think seeing DOGE as a propaganda tool is the best framing for a lot of this stuff. And just remember these, if we're going back to the negotiating tactics, go watch the Cohn movie and go watch all the stuff about this. This isn't really surprising that this is the playbook. And even if it's not the way you or I would go about doing it, we have to figure out how to respond and react to this in real time with our portfolios, with the people we're taking care of, with the stuff we're doing. So you look at the playbook for what it is, and then you respond accordingly. And that means discounting a lot of it at face value, including like, we're going to find $1 trillion of waste. Back to that stabilizing point too. Even if you find some of these large amounts of money, if the problem is with Medicaid and Social Security payments and you cut a bunch of spending, you create a new problem that shows up in some future period of time. These things all have ramifications. We're going to find out what works and what didn't, but we're having a conversation about the wasteful spending. Some of this, I think, has got to be net good. I just hope none of it's too net bad.
So we talked about this idea of short-term pain for long-term gain earlier, but in these clips, we're going to get into a little more detail around that. So this is one where actually both Andy and Cullen agreed in terms of what the short-term impact of these things might be. So here's them talking about the short-term impact of these policies.
If they cut spending really quickly and they are, there's kind of 3 arrows here, and, those arrows are cutting, the tariffs, cutting government spending, and then the immigration policy. If those 3 things have enough of a negative impact on growth, the irony in all of this is that the economy goes into a recession, and then if enough people lose their job in that sort of environment, what happens is we have automatic stabilizers that kick in, which basically means that unemployment benefits boom, and the government tax receipts collapse, and then mathematically the inverse happens of what you wanted to happen in that environment, where you fall into a recession and government spending explodes because unemployment claims explode and tax receipts collapse, which means the deficit explodes. And so you get an environment that looks, a little bit, not necessarily like COVID, but like any recession, where the deficit expands just because tax receipts collapse and these automatic stabilizers kick in, where people jump on unemployment benefits for, 9 to 12 months. And you get a big deficit by trying to cut spending. And that weirdly looks like an increasing risk as a result of a lot of this policy.
Deregulation is a short-term and medium-term pro-growth disinflationary policy, and something that the Besant team has been saying is their big thing. so that's a good thing. That's a good thing for markets. It's a good thing for the economy to have pro-growth, pro-real growth, disinflationary pressure. But the rest of the policies, starting with immigration, are anti-growth. When you reduce the labor supply, that means you can produce less. And so the pace of labor growth in the United States has essentially flatlined. And so that should be anti-growth. And then there's expenditure cuts. And expenditure cuts are happening in two ways. One is the reconciliation bill, in which the bill that's now in the midst of being passed is cuts $1.5 trillion, primarily from the poor through cutting of Medicaid, income assistance, and food stamps. So that's when you cut the government expenditures, that's anti-growth. It may be desired. Maybe the government's too damn big, wasteful, not efficient, but it hits growth. There's no way of two ways about it. So that's anti-growth. DOGE is, the expectations for DOGE are pretty light. I think it's very partisan, but the middle of the spectrum sort of sees DOGE maybe successfully reducing waste, fraud, and possibly muscle and bone from spending that is between $100 and $200 billion per year. There have been claims of 2 trillion. There have been claims that nothing is happening, and I think that's a partisan thing. What I think is built into market expectations is pretty low for how much expenditure cuts are going to happen. And that's partly because it's very hard to legislate, that some of the expenditure cuts aren't going to change the budget. And so you have Congress that has to get on board with that, but they also have some tax cuts that they'd like to do. So there's that. And then I guess the last thing, which is getting all the attention, undeserved in my view, but all the attention in markets, is tariffs. And tariffs have a negative hit to growth that is a level change in growth, and a positive, an inflationary level change in prices. And so add them all up, that's a fairly anti-growth set of policies.
The key point is, in the short term, and as we're seeing in the market today, in the short term, economically and for the market, this is probably about suffering some pain in order to achieve some long-term goals. I mean, if you think about it, immigration, as he pointed out, not great short-term. Tariffs, not great short-term. Cutting a bunch of government spending. I mean, whether you think it's wasteful or not, that money, those people were investing money in the economy. Again, not great short-term. So we just have to understand as investors, like whether we believe in this or we don't believe in this, we may have some short-term pain coming depending on the degree to which these policies are implemented.
The deregulation, and this is one thing with longer term investors I try to keep harping back to, the net result of where these policies take us, like much of the deregulation in the medium to long term, is pro-growth. Right now, to Andy's point, we are very much stacked with like anti-growth or growth slowing stuff first. But if the growth slowing stuff leads to deregulation in a bunch of industries, helps broaden out trade, helps broaden out investment broaden out investment, maybe not broaden out trade. That's probably the wrong way to put it. But if the deregulation stuff is allowed to sit and simmer over the medium to long term, that's the stuff that has to keep you optimistic here. If we miss the extended bear market and recession and back to stagflation and all the nasty stuff, you've got a pretty nice reset going on right now with a bunch of spending coming in on the other side. And oh, by the way, global, maybe not globally coordinated in the way we'd like to do, but there's about to be a lot of spending going on in the world as we retool some of this stuff. One way to look at this and say short-term pain, but I can see where the upside can come out of this on the other side and why it could be pretty strong and resilient.
Yeah, and thinking about it just from a market perspective and not from a political perspective, Darius Dale I was on that same podcast, was making the same point you did. I mean, he thinks there's more room to run in the bear market, but he also sees a lot of positives on the other side of it in terms of deregulation and what some of this stuff might do. So he's not thinking like this is a long-term catastrophe. He's thinking this could get worse in the long term, but it could get better. And, all of us can disagree about that stuff. And our job as advisors is just to talk to our investors and make them understand the potential implications of this. And that's what I wanted to get into in the end here, because that's really, you and I are talking to clients all the time. And even as we're recording here, we've probably got some calls we'll have to respond to when we're done. And I just wanted to ask you like how we think about talking about this, because it's challenging. I mean, these are politically charged issues. A lot of times you have clients who are on one side or the other, feel really strongly about it. It requires like thinking about what the market's doing long-term versus short-term. So there's really tough balances here. And so I wanted to ask you, how do you think about striking those balances when you answer questions about this?
Yeah, we invest, like we hold risky assets for the long term. So we hold stocks for the long term. When we hold even like private credit, and when we hold private equity or hedge funds or anything, a lot of that stuff we are holding for the long term. We're willing to accept volatility with this. On just the pure like stocks, markets, companies side, right now the playbook they are being dealt is not really clear. There's a lot of fuzz, there's a lot of haze inside of this. But as this starts to settle down, so long as you believe companies aren't, in the business of going out of business, they're going to make some decisions around this stuff. We should have some less regulation with some clear policy guidance and rules, and probably incentives from the government directly on the other side of this original wave of destabilizing, relatively anti-growth stuff. If there's any optimism to be taken from what's going on right now, it's please, 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 how do we look forward with our risky assets 6 months, a year out? Think about what that environment looks like when some of these corporations go, okay, here's the money we are committing to building that new manufacturing facility in the US instead of that share repurchase program. There's a lot of stuff like this we have to think about that in the short term might be, we go back to Chris Mayer's like twin engines thing. The fundamentals might be slowing. The cash flows and the earnings and the other stuff might have to slow down first. The multiples might be compressing, and they might have further to compress, especially in the environment that we come out into. But this should be a better playbook for companies to play by. And for us as long-term investors, we want to take these examples, take the historical examples and go, we've got a greater than 10% drawdown right now. 10 to 20% is probably the sweet spot where most of the times in history when this is happening, you want to be rebalancing, you want to be re-adding, you want to not be panicking. We are in that zone. So don't do anything rash, check in with the long-term plan and think opportunistically. We're getting closer to that point in the drawdown where if you have time horizon, the opportunity is here for you to seize.
That's basically exactly, I got an email from a client this morning, like wanting to add more, which is great. Like I haven't gotten any panic calls today. I've just gotten wanting to add more. And that was basically my take on it, which is they said, should I add more or not? And I said, you know what, looking out the next year, your guess is as good as mine. I have no idea how it's going to play out. But situations like this, if you look at them historically and you looked at them over multi-year, long-term time horizons, adding during times of this, when it is a fit with your risk tolerance, was usually a good idea. We can't say that for sure, but it usually is. And I think if you think about it in that context, that's the right way to look at it. If you're thinking about, I'm going to add in, a month from now, I think the market's going to be higher, you may be better than me. Good luck with that. But if you think about it long-term and you do it in small batches and you add during a time like this, most of the time that ends up working out over a really long period of time.
Yeah. And the great part about here is if you don't just have a Mag 7 portfolio, if you have a remotely diversified stock portfolio, let alone if you have a remotely diversified total portfolio with bonds and real estate and all sorts of different stuff in it, you've probably been rebalancing away from stocks for the last 2 years. We had two very much above average return environments, 2 years running, back to back, 20% plus US equity returns. If you did anything to take any money off the table and put it anywhere else, you harvested above average gains. And now we're entering into an environment where you can rebalance back into some of those categories. Basic portfolio management, when you say, I can't predict, I can't project what the future is, but I know how to behave in better than average environments and worse than average environments, same playbook. It felt frustrating to rebalance and watch stuff keep going up the last 2 years. But if you did it, now is what you did it for. There's work to be done.
So with that, everybody can queue up the angry YouTube comments, which I'm sure will be coming despite our attempts to say we're trying to do this down the middle.
I can't wait to find out if we're, woke lefties or pro MAGA, whatever, or somebody out there is going to leave the comment that's going to say, thank you for being relatively down the road and not trying to pretend you're married to one of these camps, which I know you and I both just resist the feeling of, like, can't we just be relatively independent? Isn't that an okay thing in the world?
I mean, obviously I'm going to add that comment from my anonymous account. So you could expect me in there commenting, just complimenting what a tremendous job we did of taking it right down the middle.
You and me both. Let's go pad those comments, Jack.
Well, thank you everybody for joining us, and we'll see you next time.
Thanks so much for tuning into this episode. If you found this discussion interesting and valuable, please subscribe on YouTube or your favorite podcast platform, or leave a review or a comment. We appreciate it.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of the participants or their clients.